Friday, February 9th. Forgive my attire. It's a little cold and drizzly and freezing rain outside. Another week dominated by stock market news. There's not enough going on in the stock market to cause the Fed to pause or to reverse its intentions. And there's not likely to be enough going on in the stock market to do that. But the action has caused some pause in markets. And so mortgage rates have ended this week where they were last week. Everybody expects them to go up from the 4.5 where we are now to 4 3/4, maybe 4 7/8, and probably briskly. But the adventure in the stock market may slow that down as a market event, not a Fed event. Speaking of the stock market, there's all kinds of noise out there about what is happening and why and who shot John. A tremendous number of Wall Street salesmen running around basically trying to find a reason that their clients have lost a lot of money and it's not them, which is traditional. And the main thing in the stock market to remember, and especially if you look at the charts, the stock market chart that's in the copy next to this video, nothing has happened except it went up too far too fast. Simple as that. In Dow terms, the Dow at the bottom of the Great Recession was at 7,000. By 18 months ago, 15 months ago, just before the election, the Dow was 18,000. So it had not quite tripled from the bottom of the recession. The prior top, prior to the Great Recession, was 14,000. So making it to 18, yeah, okay, I get that. You know, we're in a recovery. But in 15 months since the election, we've gone from 18,000 to 26,000. Markets that quadruple in 10 years are not likely to hold on to all of the gains. And one of the signals is the chart pattern that, you know, going from a nice diagonal line like this upward, all of a sudden it does this. This is the part that we're not going to hang on to. So my hunch is that stocks are deeply vulnerable to going further down. They're not likely to go down below that 1,800. This is not, 18,000. This isn't a crash situation. Which leads to the last piece that you need to know. The most favorite line on Wall Street today is that the Fed and other central banks generated a tremendous amount of cash, which is migrated to the stock market and other financial assets, and we're all going to die. This is going to be worse than global warming. This is, I mean, on and on and on. And it's all the Fed's fault. Don't believe any of this. What they're selling is the idea that if the Fed withdraws the cash that it put into the marketplace, then nobody will ever buy a share of stock again. The reality is that the central banks were invented 150 years ago to intercept economies that were either downward spiraling or upward spiraling. And it's the job of the central bank to intervene. Now, when we're coming out of a Great Recession, and the central bank has done what it's supposed to do, it generated a great deal of cash and credit. The Fed began to taper that in what is still known as the taper tantrum 5 years ago. It's not sudden. It's taken other steps in that 5-year span to back off from the hyper-stimulus that got us out of trouble. But the Fed's not the only moving object. In an economic recovery, the economy recovers, meaning corporate earnings, economic activity spreads and becomes durable, and that takes the place of the Fed stimulus. So the Fed drains with one hand while the economy is giving back by the other. And if it gets it calibrated right, there isn't any reason for a stock market to do that. It shouldn't do that, but to do that is perfectly reasonable. So I would beware of, especially the salesmen who are out busily trying to blame somebody else. As I wrote nearby, those who can't stop blaming the Fed, who deny that stimulus was necessary or that the Fed did any good, they remind me a lot of my 50-year-old friends who never got over mommy's mistakes. On that note, have a good weekend.